John Nigerian is a guest which we have frequently on my television show, The Income Generation. And you see me introduce him all the time as an options specialist, but you might be wondering, what the heck are options, right? Well, options are basically the derivative of a security. Okay, Dave, yeah, not helping much. That's even more complex. What's a derivative? Well, a derivative is something that isn't the security itself. It's a separate contract, but it derives its value from the price of the security. Okay? Now, in the case of an option, it's really exactly what it sounds like. Let's take a stock option, right? It's, if you buy an option, you own an option, what you have is a contract that gives you the right, or the option, if you will, to buy the stock at a certain price over the next certain number of months. Okay? So you may see a stock right now at $50 a share, and you may think it's going to go up to $55. I think it's going to go down. Okay? So you and I enter into an options contract. And you say, Dave, I'm willing to pay you 75 cents for the right to buy the stock at $50 for the next 9 months. Okay? So if the stock goes up to 55 or even better, 60 or 70, you're a happy camper because now you get to buy it for 50 and it's worth immediately 60 or 65 or $70. So boom, you have instantaneous profit. Okay? I collected your 75 cents. That's what you paid me for that right, for that option. And I got to, the stock came up, but then I was forced to sell it to you at $50. Okay? But what if the opposite happens? What if the market drops? What if the stock drops to $40? Well, when 9 months goes by, your option is going to expire worthless. But I get to keep your 75 cents. Okay? So if that $50 stock pays a dividend, I've just enhanced the dividend by 2%, let's say, when you extrapolate over the course of a year. So that's what an option is. You might have heard of options on real estate before, where you buy an option, you're a renter with an option to buy, and that option typically has a fixed price on the real estate. Well, you're never going to exercise the option if the price of the real estate is below the option price, because you'll just go renegotiate and buy from the seller, right? But if the price does go up and your option price is lower than the current market value, now you've got the right to go ahead and to buy it at that prefixed price. So the same is true in the stock market. So for those that are buying the option, they're speculating that a stock is going to go up or down. And I say or down because there's two types of options. There's calls and puts. Call options are the example I gave you when you're speculating it's going to go from 50 up to some higher number. But if you want to speculate it's going to go down, you could also buy a put. And then you make money if the stock went from 50 to 40. Okay? So the buyer of the option is speculating that the stock's going to go in a certain way and wants to lock in a preferable price to buy it or sell it. Whereas the person writing the option doesn't agree with that market prognosis and wants the income, wants to sit back and take the premium because he's willing to write the option figuring that it's going to expire worthless. Right? So again, a real complicated field. It's not simple. That's why you have guys like John Nigerian that are truly options experts. But hopefully that helped you with a little bit of clarity on the concept of stock market options.